Hey guys, welcome to Wealth Talk. Today I've got some great information. It's in December, 2020 is almost over. I'm going to show you the number one way that high net worth investors reduce their tax bill in their investment portfolios. I'm also going to show you, for those of you who are trying to implement this strategy, the number one mistake that people make and blow the whole thing up. So welcome to Wealth Talk. Today we're going to talk about some year-end tax planning, how you can save some money in your taxable brokerage account. So we all know this has been a very, very good year for a lot of stocks that we've been talking about. The technology stocks, a lot of the pharmaceutical stocks, Zooms, CrowdStrikes. So people that have been invested in this market in those types of names have made a lot of money this year. But also it's been a very difficult year for investors who maybe own stocks like airline stocks, hotel stocks, cruise line stocks, gaming stocks. Those stocks have been decimated. On average, most people hold diversified portfolios, though. So what you're going to see is while some stuff, didn't fare so well, you had a lot of things that offset that. Most people are actually up on the year. So the biggest challenge, though, is when you get towards the end of the year, is you want to see when you run the report in your brokerage account, whether that's TD Ameritrade, Schwab, E-Trade, there's something that you can run, press a button called a realized gain report. Now is the time you want to do that. You want to see in your taxable accounts only, doesn't matter in your IRAs, your 401ks, because you don't need to pay taxes on that. In those taxable accounts, what you want to see is what are those realized gains that you have year to date, because you're going to get something in January, February from your brokerage account called a 1099 that the IRS also gets that shows what those gains were, and you have to pay taxes on those gains. So let's talk about the taxes on those gains. There's two types of taxes on capital gains. There's one that's going to be taxed on short-term capital gains and one long-term capital gains. All that basically means is if you hold your stocks for 12 months in a day, you qualify for long-term capital gains. What basically the IRS is doing is incentivizing long-term investors versus short-term speculators. Those long-term capital gains rates are very favorable. It's about 459,000 in income if you're an individual, that if you're under that amount, you only pay 15%. If you're over that amount, you still only pay 20%. Now, if you're making that kind of money, most of you are in that 38, 40% bracket plus state income. So you can wind up paying almost 50% on your capital gains. So much better to pay 15 or 20% versus 50%. If you're a married couple, that threshold goes up a little bit to just under 500,000. So the key is you want to make sure that first and foremost, you could always do long-term capital gains and get that favorable rate. Sometimes though, that's unavoidable. Sometimes you have big runs up in stocks that are very speculative and you don't want to lose profits. One thing that I always tell investors is, and all of my clients are high net worth investors, everybody's in the highest tax bracket. Taxes are a biggest concern for all of my clients, including myself. But what I always say is, first and foremost, you want to make any investment, any expense based off of the fundamentals of that investment or expense. People are talking about, should I go buy Cullinans to be able to get the tax credit? Do you need a Cullinan? No, I don't really need one. All these crazy things. When you make an investment, guys, when you make an expense, taxes are secondary. The principles of that investment, the foundation of that investment, making sure that you need that if it's an expense, making sure that fundamentally that's a sound company that you believe has the basis to go up, is why you want to make those investments, not because of tax. So one thing also, guys, on the other side, if you have gains, some people have 300% gains in stocks. For the sake of not paying a tax bill, guys, do not let those gains get washed away. I've seen time and time again over 20 years of trading, people that didn't want to pay the IRS had hundreds of thousands of dollars of gains wiped out in bear markets because they didn't want to pay a simple tax bill. So don't be that person. What I will tell you, though, is you want to leverage the tax code. You want to be smart to be able to maximize your after-tax return. So one thing you could do with tax loss harvesting is you're able to basically take some of the losses, and some of those names may be like your cruise line stocks, your airline stocks that have not done so well, and offset the gains that we talked about from that realized statement. Simple way to do this: go back to that brokerage account, run your unrealized loss report. That unrealized loss report will show you every single stock in the portfolio that you currently have a loss in, even though you haven't taken that loss yet, and you could add that up. And so if you have a gain, let's say on Zoom stock, that's up, and you maybe made $10,000 on it, and then maybe you have 5 or 6 stocks that have smaller losses in, but those 5 stocks maybe have, let's call it $2,000 losses a piece. You could sell those 5 stocks, offset, pull that $10,000 loss, completely offset that $10,000 gain, even if it's a short-term gain. So even if you bought Zoom a week ago, sold it, that's technically a short-term gain. So you'd be paying that high 40-50% taxes on that. But if you use this tax loss harvesting method that I'm talking about, you can sell those losers and you can offset 100% of that gain. So even though your overall portfolio may be up, even though you took that big gain on Zoom, your net taxable income from the portfolio when you receive that 1099 in January or February from your brokerage firm is going to be zero. So that's the best thing to do if you have some gains right now, but that has to be done before December 31st. So you have to act quickly on that. Now, I told you about tax loss harvesting, and that's the number one thing, nothing out there better essentially for a stock portfolio that you can do to minimize taxes. And that's primarily, let me also mention, done with individual stocks and ETFs. For those of you who are using mutual funds, not nearly as efficient. There are some ways you can do it, but this is primarily geared towards individual stock and ETF investors where you have a lot more tax control and flexibility. Now, when you're doing this, though, let me put something in place. You need to make sure that when you sell that stock, let's say you're selling that Bank of America stock at a loss, that you do not just go ahead and buy that stock back right away. A lot of people think it's that easy. Well, I'll take the loss, show that on my report, and I'll just buy the Bank of America stock right away because I still like Bank of America stock. It might go up and I don't want to miss out. Well, you can't do that, guys. There's something called the wash sale rule. The wash sale rule basically says if you buy a substantially equal stock within 30 days of the sale, then that sale that you just used to wipe off the gain is going to be eliminated. You're going to have to pay those taxes. So you don't want to do that. So here's something that you can do. I said Bank of America stock. You sold that stock, for example. You don't want to be out of the market because cash pays nothing and you don't want to miss out if there's a run. So you might also think, well, let me go into JP Morgan stock. Different name, same sector. They're going to trade very similar. But that's a very gray area. In many cases, I think the IRS would disallow that because that's substantially an equal stock. It's still a bank stock. It's still an S&P 500 stock. I don't think that's different enough. One thing you can do, and that will work though, is you can use an ETF. There's a lot of ETFs out there, and if you screen them on MSN, if you screen them on Yahoo, anything out there, you could see the holdings on there very transparently. And so a lot of the financial ETFs, the actual number one holding might be Bank of America or a large percentage in there and has your JP Morgans and Citibanks and those names. So by selling Bank of America and moving into that ETF, those dollars, you're still going to have essentially that same allocation and potential upside. So that's the best way that I always recommend from investors that are going from an individual stock. If you want really that same type of run up, you want to move into an ETF that's very similar and may in fact hold that ETF as one of the top positions in there. That's really, really the best way to do that. Now, if you're in an ETF and you're taking profits on an ETF, it's a lot easier. You can just, maybe you're in an iShares ETF and you want to go to, let's say, Spiders ETF or Wisdom Tree ETF, that's similar. You can do that. There's no issue. What I would say though, the best thing to do is go to a different company. So if you're in a Spider share, maybe go and buy the Vanguard share just to eliminate any confusion. But that is tax loss harvesting. It gives you a very, very good idea of how to do it. It's very simple. Avoid the dreaded wash sale rule. That's the most important thing, to make sure that that's not eliminated. Again, this is primarily for individual stock and ETF investors. It's a great strategy. You've got about 20 something days left to do it. Make sure you run those realized gain reports to see what your gains are, and then the unrealized loss report to see what losses you can make realized, meaning go in there and sell those to offset those gains. Great strategy to implement. Look forward to talking to you on the next talk. Now, if you have not subscribed, I give out free information, guys, like this every single week. Click that button below, subscribe. There's a bell, ring that every week. You'll be notified when there's new content. If this was valuable to you, please leave a comment below. Also, I really would love to have some more questions. If there's anything else you want me to talk about on Wealth Talk, go ahead and pop in those questions below. I'll answer them in the following week. If you like the content, share it with a friend. I appreciate you. Have a great week.